Hello everyone and welcome to session number 5 of business analysis. And today we will continue with part 2 of the seduction of large opportunity size. And as we all did in part number 1, we discussed 4 logics, right? Because of which managements and capital market professionals love to have a big opportunity size in a company. We also understood that the contra of large opportunity size, that is a niche market, a small opportunity size. Even companies can create magic being a niche. So the rule is technically there is no one rule. Okay. So today we'll be discussing few more logics of why a big opportunity size is desired in capital markets. And we will be discussing few case studies where we'll be discussing 2 examples where reinvestment rates, the topic that we discussed in session number 1, when companies stop reinvesting more into the business for growth, how market reacts in terms of price and the valuation multiples. And we'll discuss 2 case studies of companies where reinvestment rates have consistently been high and how markets have rewarded them in terms of their price performance or market cap performance or the valuation multiples. Okay. So first let's discuss 2 more logics of why high growing opportunity size is desired. Now, I heard this statement first time when I was reading a blog by Professor Sanjay Bakshi sir, that there's a concept called as hedonic treadmill, that you keep on running, but you are in the same spot. And that's a very bad thing for an entrepreneur and for a business model in particular. So imagine you have currently a 10,000 crore industry size. Now let's imagine it is a newspaper industry. And as you see clearly, the trend newspaper industry is degrowing. Okay. So you believe that, after, 5-10 years down the line, the newspaper industry will only be worth around 7,000 or 8,000 crore. Okay. 5-10 years down the line. Currently, your company has a market share of, let's say, 10%, leading to a top line of 1,000 crore. Just to manage your current top line after 5-10 years down the line at 1,000 crore, that is practically a 0% growth. Your company will have to approximately have a market share of 15%. And from session 1, we know that gaining market share is one of the most difficult things, because you will actually have to sell more volumes, more newspapers, convince more customers to leave competitors and use your product, right? Even after doing all the effort, we are basically standing at the same point. Even with a higher market share, our top line growth is 0, running on a treadmill, right? No one likes it. It is one of the worst things that can happen to a promoter. So that's a logic. People want a growing market rather than, constant market or decreasing market in particular. The 6th point is the magic of a story. Now, in every market, be it a bull market, be it a bear market, be it a chicken market, which is doing nothing practically, people need a story, right? And if you have a good story, it becomes easy to raise money. Now, whether you are a promoter who is raising money from venture capitalists, or you are a fund manager who is raising money from your clients because you have good stories to allocate portfolio to, this is a common trend of capital markets. Be you are an investment banker, right, who wants to raise good money for IPO or QIPs, etc. Now, this is nothing wrong. This is nothing bad. This is something which the consumers themselves desire. So, we have written a basic pitch of how that pitch goes like. Let's imagine you are a fund manager, you are sitting in front of clients and you are raising 1,000 crore for your new fund. And obviously all the clients would have question ki aap 1,000 crore kahan pe lagayenge? Explain us in which kind of companies you will invest our money. Can 1,000 crore be invested in some ideas? Do they have such kind of potential that they can absorb capital of 1,000 crore? That's the main point. 1,000 crore लगने की जगह भी तो होनी चाहिए, right? Industry में, so the basic point is, imagine if industry size is 200 crore, And as per your industry's characteristic, companies generally tend to have an asset turnover of 2. That means on 100 crore of fixed asset, you will be able to generate twice, 2 times the revenue. That is 200 crore of revenue. You see, the industry is exhausted, right? Because industry ka size kitna tha? 200 crore. That means this industry can absorb capital of only how much? 100 crore. So आप 1000 crore कहाँ लगाएंगे? So कहाँ पे capital ज्यादा लग सकता है? कहाँ पे बंदे एसेट ज्यादा लगाएंगे? जहाँ पे इंडस्ट्री साइज बड़ा है, जहां पे कैपिटल एब्जॉर्ब हो सकता है फॉर अ वेरी लॉन्ग पीरियड ऑफ टाइम, दैट इज कॉल्ड अ स्टोरी. एंड कहां पे कैपिटल ज्यादा एब्जॉर्ब हो सकता है? जहां पे ट्रेंड नया नया आया हो कि ये चीज तो अभी चालू हुई है, इंटरनेट पेनिट्रेशन तो अभी चालू हुआ है, इंडिया के अंदर स्पेंडिंग ऑन डेटा इज जस्ट 50 और 100 रुपीज, whereas in US or Europe people are spending 1000 rupees or 2000 rupees per month on a data. So we have lot of potential to grow. That means lot of data consumption will happen in the coming 10-15 years. That means the telecom company will have to put lot of towers over a period to capture this data, and for that a lot of capital will be required. So it is a long-term growth story. Give us money, we will invest there. Nothing wrong, nothing bad, but people like to invest in consumer trends which have just started and which will be there for a very long period of time. So if you have some themes, those are also called as themes or stories, right? Renewable energy is a theme, right? Electronic vehicles is a theme. If you have a theme or a story जहां पे कंज्यूमर का माइंडसेट अभी अभी चेंज होना चालू हुआ है, you can pick some few things which you think have a long term trend and can pitch and raise money. You cannot raise good amount of money by communicating कि 4-5 बिजनेस में ट्रैक कर रहा हूं, उनका आने वाले 2-3 क्वार्टर का रिजल्ट अच्छा आएगा, so give me money. Point is, although it is a truth that churn will happen in portfolio, you will end up removing 5 companies out of 10 within 2 to 3 years from your portfolio. But it's the unsaid part. People don't like to speak much about it. What people like to speak about is the remaining 5 businesses that they have held for 3, 4, 5 years. Okay, we find long-term structural stories with huge opportunity size so that we can consistently invest there. And why we are able to consistently invest there? Because company consistently is able to grow by investing more into capital. So that's the magic story of raising money. And for that, people desire business with good opportunity size. So concluding all the logics here in the summary. So if a business has a combination of having sales revenue growth at approximately 10-15%, or and combined with a profit growth of 15 to 20%, right? Combined with a return on equity, which is anywhere above 18% and 20%, combined with a high reinvestment rate, the thing that I explained, right? If a company is earning, let's say, PAT of 100 crore, and they are investing 70 crore back into working capital or fixed asset or R&D, right? That means they have a reinvestment rate of 70%, 70 divided by 100. If they have such kind of high reinvestment rate, and why would they invest more? Because obviously they have a huge opportunity size. So this combination, 1, 2, 3, higher investment, high opportunity size, these 5 parameters, if they are present in a business, it goes above the roof in terms of demand from people wanting to be its shareholder, and thus the valuations. Okay, so now we'll go and we'll look at few case studies, where the reinvestment rates have come down and where reinvestment rates have stayed high or even increased, and what has been the reaction of market participants on the same. Now the case studies that we present here, again, they just represent one angle of the story. There might be various other angles too, because of which the stock price moved up or moved down, but we want to just focus on the growth aspect right now, the reinvestment aspect, right? Again, we are not SEBI registered investment advisors. We are an education academy. We as a company, we don't manage people's money. So please just take it as an educational post. We have nothing for or against any companies here. We may or we may not be invested in any case study that we discuss here. And as it is, we are not at all talking about buy or sell or good or bad future of this company. So as it is, that is out of picture. So case number one, that is Hawkins Cooker. So everyone knows that, Hawkins Cooker is a great household name. Hawkins, TTK Prestige, right? They are one of the biggest cooker brands in India. And when you look at, Hawkins over a period of time, so this is a sort of table that we like to prepare, and we teach our students in the academy to prepare, both in the FinBridge FinPlus program, that you should have an idea about the broad business characteristic of a company. See, so first of all, you collect basic data. So see here in the notes section here, you have actually mentioned the source from which this data is to be extracted. So you extract EBIT, that is operating profit, or called as earning before interest and tax from P&L. You extract income tax paid from cash flow from operation statement. Then you calculate NOPAT, that is net operating profit after taxes, by doing EBIT minus income tax paid. You take fixed asset from the footnote of assets, that is asset schedule. Similarly, you take inventory, debtor, paid, payable from balance sheet, directly from balance sheets. And yes, all numbers should be taken from consolidated financial statement per se. Then you calculate invested capital. Now, invested capital is assets plus working capital, tangible fixed asset, intangible assets plus working capital. So basically, if you pick up, let's say, invested capital of 2016, that is 10,480 lakhs, it would be a summation of fixed asset plus intangible asset plus inventory debtor minus payable, right? Because payables are actually a reduction in working capital. Or we have also calculated working capital directly. This number 8285 is nothing but fixed asset plus intangible asset, and working capital is nothing but debtor plus inventory minus payable. So you can directly do fixed asset plus intangible asset plus working capital also. You will get the same number. Okay. So you get invested capital. Now you take debt and equity there. Now debt includes both short-term and long-term borrowing. You will get it from balance sheet. Total equity includes share capital plus retained earnings, that is reserves and surplus of the company. You get it from balance sheet again. And capital employed is nothing but summation of debt plus equity. Okay. So you add both of them, you get capital employed. So you collect the data in the first table, then you calculate few ratios, that is return on capital employed. That is nothing but NOPAT, net operating profit after taxes, divided by capital employed. We have mentioned the formula here. That basically shows that business as a whole is earning what return, irrespective of the capital structure. कि business को grow करने के लिए आपको capital चाहिए. Capital के दो format होते हैं. You can raise money either through equity or through debt. But debt पे interest आता है. So if I forget के वो capital जो business के अंदर लगा वो debt का था या equity का था, just let's assume it to be total capital. तो total capital में आपने क्या return कमाया? That is called as return on capital employed. Now, because you are considering here debt as equity only, so the basic structure of format is EBIT minus interest, right? Then you have minus taxes, and you get finally profit. And EBIT minus interest करके EBT आता है, profit before tax. So imagine if your EBT is 100 crore, your interest is 10 crore, your earning before taxes would be 90 crore. Imagine your company comes under a 10% tax bracket, so tax would be 9 crore, and you will have a PAT of 81 crore. But to calculate return on capital employed, right, you are considering total capital. That means you are considering all the capital as equity. मतलब company debt, equity कुछ भी use करे तो क्या होता? Total capital पे क्या return आया? That means ये interest नहीं आएगा, right? क्योंकि आप debt को debt count ही नहीं कर रहे. So EBIT would be nothing but 100. Interest would be 0. So technically, profit before tax would be nothing but EBIT only, right? That is 100. Now you will do cash taxes paid here. That would be, now here it would be 10 rupees because 10% आपका tax लगेगा 100 पे, and you will have PAT of 90. Okay, and here you original PAT was 81, right? So practically when we do EBIT minus taxes paid to get no PAT, right? We are actually calculating PAT of a company, but assuming no interest cost. Okay. That's the basic logic here. So you calculate return on capital employed of company, and then we calculate return on invested capital of the company. Now, return on invested capital is calculated at same NOPAT, but we only divide it by the core assets of business, that is invested capital. Because a company, let's imagine you have a balance sheet, you have 100 rupees of equity and 100 rupees of debt. Now you have broadly 200 rupees of capital. Now this capital can be channelized into core assets or non-core assets. Imagine your company has 30 rupees in mutual funds and only 170 rupees into fixed asset plus working capital combined. Now the profits and returns, because we are talking only about operating profits, the profits and returns that your company is generating is on this 170 technically, not on this 30. So taking this 30 as capital invested into the business is technically wrong. So you take NOPAT in the numerator and you take only this 170, that is invested capital in denominator. That is why it is called as return on invested capital. Okay, that is why it is very important that when you calculate EBIT, right? EBIT is technically calculated as revenue of the company, or you can take total income that is available in P&L. For actual understanding of 9 items, you can see our financial analysis series on YouTube or blog on financial analysis. We have explained every term with live snapshots of annual report very clearly. Okay, so you take total income minus you do other income, because other income is included in total income. But for calculating ROIC, boss, we are not taking into account non-core assets, so we cannot take into account non-core income also. And you do all the operating expenses, you deduct depreciation, and then you technically get EBIT. So ये आपको बनाया बना P&L के अंदर मिलता नहीं है, आपको ये वाला EBIT, that is called as core EBIT, ये आपको calculate करना पड़ता है यहाँ पे. So you take core EBIT and then you do income tax paid, you get NOPAT. So that is ROIC. Now, what you do is you calculate growth in NOPAT. That is new minus old divide by old. के 2012 से 13 पे कंपनी का NOPAT कितना ग्रो किया. So see, in Hawkins case, the NOPAT grew by 13% a year. 13% in 2013. Now, why this is important? This we have also explained in our valuation series forum blog and also on our YouTube channel under valuation playlist, that this is a golden equation in finance, in business. NOPAT growth is equal to reinvestment rate into ROIC. अगर आप बिजनेस के अंदर लेट्स इमेजिन 25% का रिटर्न ऑन कैपिटल एम्प्लॉयड कमा रहे हैं एंड आप अपने प्रॉफिट्स का 50% वापस से बिजनेस के अंदर रीइन्वेस्ट कर रहे हैं, it's simple math. The profit growth will be 12.5%. We have explained the entire logic in the valuation series video, I think third video on our YouTube, and you can read this, the same blog on our forum to under valuation. So coming straight to the point, you calculate NOPAT growth. Okay, first of all, now we are actually reverse calculating reinvestment rate. See, we have calculated NOPAT growth here. We have already calculated ROIC above. So what will be the reinvestment rate of Hawkins? Nothing but at NOPAT growth divided by ROIC. Okay, so that is this number, and the formulas have also been written here. Okay, so this is the reinvestment rate of Hawkins. If we leave aside the last 2 years where the company found a bit of its mojo back, they wanted to start growing again. If you look at the broad reinvestment range of Hawkins, leaving aside one exceptional year, it has been consistently on a lower trend, and the company is only reinvesting 10 to 15% of its NOPAT. That is net operating profit after taxes. That is nothing but, remember, PAT, assuming debt is also equity, nothing but only 10 to 15% of NOPAT back into the business for growth. Now, that's a very low reinvestment rate. That's technically a very low reinvestment rate. And if you see, because, and Hawkins is a asset intensive business, right? It is not an asset light business. You need to invest in assets and working capital for growth. Look at the period, especially since, this junction, since 2015 till 2019, where reinvestment rates practically went down the drain. Look at how market traded Hawkins during this period. Look at the peak of 2015 and look at what happened till 2019 end, because in 2020 reinvestment rates have started again to pick up. Look at this duration of 4 to 5 years. Complete consolidation in stock price. And the funny thing is, this includes the crazy bull market of 2016 and 17 into small cap and mid cap space, where stocks went up by 3, 4, 5x. Every Tom, Dick and Harry stock went up. Even during such a bull phase of market, it practically did nothing. You didn't. So it's not like you made zero losses in Hawkins. You had a big opportunity cost that you lost that you could have made in other businesses. Similarly, look at what happened to the valuation multiples of Hawkins. From a PE ratio of 65 to 70, practically got derated to 30 ka PE. That is almost a 50% correction in stock valuation. And now to understand more about PE, re-rating, de-rating concept, again, visit, I think, valuation valuation series video number 4 or 5, where we have discussed the topic of PE re-rating and de-rating. Okay, why PE re-rating is a good thing and PE de-rating is a bad thing in a business. So practically valuations got shattered of Hawkins, right? And again, open disclosure, guys, we don't have any positions in Hawkins or the next case study Castrol, and we may mean the business is good or bad. This is just one angle we are trying to put forward. That's it, nothing else. Next case study is Castrol. Now, you won't believe, but Castrol's return on invested capital, people say na in market कि एक quality company का return ratio बहुत high होना चाहिए, ROE, ROIC. Boss, company's return on invested capital of Castrol is 200%. मतलब ₹1 के invested capital में forget revenue, they make ₹2 of net operating profit after taxes. It's 200% ROIC business. But you want to see what has happened to stock prices of Castrol? Look, the past 7 years. It's a complete destruction of wealth. The main theme that strikes is when you look at the PE ratio, from a high of 55 ka PE multiple, the company today trades at 18 ka PE multiple. Such a huge destruction of wealth has happened in business like Castrol. Why? Because look at their reinvestment rates. 7, 1, 5, 1, 0, 2, 12, negative 66. Practically, Hawkins is not reinvesting anything back into the business for growth. Just nothing. Now, if it would have been a very, very asset-light business, it would have been, still okay. But, the main reason is the automobile lubricant market where they operate in. The industry has got a bit saturated. It's not growing. It is hardly able to keep pace with the GDP growth rate. And the company has not been able to innovate a lot with great products so that they can reinvest back into development of those products and grow again. So just one angle that we should keep in mind. But whereas if we pick up two other companies, two companies that we have tracked, one is PI Industries and one is Page Industries. So we are invested in PI Industries, right? That's open disclosure. So but we are not into Page Industries. So if you look at PI Industries, if you go and analyze the segmental revenue of PI, we have, collected this data from annual report, con calls, investor presentations. It's not very clear cut available in AR. Look at 2012 ka data. So company basically used to operate in two segments, that is domestic agriculture market, that is co-marketing and in-licensing, and custom synthetic manufacturing, that is a global export market majorly. So in 2012, company had approximately 370 crore from CSM and 500 crore from domestic market coming in. Look at what happened in 2020. The CSM segment actually approximately went up 8x, 7 to 8x. The segment which was just responsible for 40% of the revenue today contributes 70% of the revenue. A huge scale up in top line happened in a space of 7 to 8 years in PI, right? So if you go, and again, now they were practically CSM and domestic, both agrochemical market. That was their forte. Now they are again planning to increase one more segment in the company. That is also under CSM, but that will be more into API, active pharmaceutical ingredient pharma industry space, into mainly into non-patented side initially. So they are trying to acquire few companies. Their recent deal, I think with InSwift, actually failed on last or second last day of due diligence. But coming back to the main data that we are focusing on, if you calculate all the data points like we explained in Hawkins, and you look at the reinvestment rate of PI, the average of last 10 years in PI, the average reinvestment rate has been approximately around 140%. But if they are running 1 rupees in profit, they are actually reinvesting 1.4 rupees back into the business. Such was the kind of growth they were seeing in the custom synthetic manufacturing segment. And it is an asset heavy segment that on 1 rupee of asset, broadly you generate 1.7, 1.5 times of revenue on an average. So to have more revenue, you need to, plow back more money into the plant and equipment, fixed asset space. But the company has grown reasonably well and reinvestment rates have been high. But a very important point that I would like to state here is that not just high reinvestment rate is good, because a lot of loss-making companies keep on reinvesting more into their business, but still market doesn't even look at them. The main point is, and I'm repeating it again and again, the return on capital employed or return on invested capital should be above cost of capital. Okay, point number one. So generally, as we discussed, right, in business analysis session number 1, why a major characteristic of a good business is at least a ROC, ROIC of 12.5% and above. So that is the minimum cutoff. Now, obviously, it should be much higher than the minimum cutoff, greater than 15 at least. And if it is high, in the range of 15, 20 or 25% range, it should have remained stable there, or it should have increased, but it should not be on a declining trend, the ROIC. So if ROICs are much higher than 15% and they are stable or increasing, this trend combined with a high reinvestment rate, that's a magic moment to get high valuations and to attract market participants to your business model. Similarly, look at the price and the PE ratios of PI industries. Since 2012, the company has been perpetually on sort of an uptrend here, right? And the valuation multiples of the company, again, if you look here, has been stable at a high range, right? Approximately 40 to 50 ka range the company has been able to maintain for last 7 to 8 years, because they have been able to consistently grow. Right now, we are not debating whether 70 ka PE was justified or not. We have already talked about that in valuation series. We are just trying to understand through examples how markets react. Now, similar case study, if you take in terms of Page Industries, you all must know them with the brand name Jockey. So Page, I think in 1995 they started with men's undergarment manufacturing, which was a 10,000 crore market, right? Now, till 2019 and 20, they were able to expand their opportunity size. Like from men's innerwear, they went into women's innerwear, right? They went into leisure wear, boxers, shorts, t-shirt. They have went into kids wear also. They also are into sportswear through Speedo brand, right? So they have expanded from a 10,000 crore opportunity size to approximately a 45, 50,000 crore opportunity size. Scale up. And this requires reinvestment, right? So on an average, the reinvestment rate in Page has been around 60%. So Page has been able to generate free cash flow also, apart from, growing the business. So free cash flow is nothing but your cash flow from operations minus capex, right? So that's a great sign. And again, if you look at a Page, they had some, channel issues at the time of demonetization and a brief 1 year slowdown. in revenue. But apart from that, majorly speaking, the company valuations have sustained, right? The company's PE multiples have sustained. So again, a great thing to look at. So with this, we can conclude that the holy grail is having a huge opportunity size, a management which can execute with great products like what we understood to the example of PI or Page, so that you can capture some portion of that big opportunity in front of you with reasonable ROIC over and above cost of capital. You can have, a huge boost to the valuations of your businesses. So this was the final part of session number 2 that we wanted to talk about. With this, we conclude the topic of the seduction of high opportunity size and industry size. Okay, we'll welcome you back in session number 6 with a new topic. Please follow our YouTube channel, subscribe to it so that you get regular updates on all the valuation series, financial series, business analysis series, the videos that we post about. You can also visit our website, financialsharkclasses.com, go to the forum tab here, right? It will, we publish great articles here. We share great articles written by other investors in the market. You can go to the forum tab. I will show you here. Here's the forum tab, right? So we contain a lot of categories here: current awareness, business analysis, financial analysis, valuation, top blogs. Basically here we share great blogs that we read, which are published by other capital market professionals, right? We have written extensively about lot of business personalities, their investment philosophies. We share our transcripts, our summary notes of good investing webinars that we like, our key excerpts and summary notes of great research papers or investor memos that we read. So you can go and please read these things on our forum. If you are in the mood for short, funny, yet quality content, you can visit our channel on Instagram. We go by the name financial_Shah. And if you are in the mood to read, short, a crisp version of our main forum blogs, you can go to Twitter and follow us on, we go by the handle at Finacle Academy. There we post, great short threads on good relevant topic that we would like you to know more about. So with this, I end session number 5. We'll see you back in session number 6. Thank you.